Hi folks, welcome back. This is our weekend commentary for the ICT Mentorship for April 8th, 2022. All right, hope your homework assignment that we're supplying to you for drawdown reduction for the month of April, hope that's going well for you. Dollar index daily chart. All right, so we have this little area in here. Right there. Now, originally I had it in here. And I said if we get through that, then we'll look at this. And that 100 big figure, which obviously we got that. Okay, so I'm showing you here where those levels are anchored to. Originally, again, they were here. So now this is the other one I mentioned. Go back and listen to the audio commentary of the dollar index the last week or so. And you'll see that I mentioned this very thing here. That was the draw on liquidity. And obviously, it may not be done, but we'll cross that bridge when we get there. But for now, let's get a little bit closer look. All right, about, I don't know, 2 weeks ago, I mentioned that we had that volume imbalance in here. We traded down into that reaccumulated, sent it higher for the buy side liquidity. It drew into our targets. It went to our objective at 100. You can't ask for more than that, folks. It is what it is. Concepts are working as you would expect. So that draw on liquidity, we've seen pull the dollar index higher. It swept the $1 mark and then pulled off of that level. And does it want to come down and sweep up any of the sell side liquidity in here? That's one of the concerns I have going forward. And I don't know. You know, it's the weekend. I don't know how Sunday's going to open. You never know what's going to pop off, obviously. But the bullishness, we're trying to avoid picking the top. We're not trying to call a top. But I'm going to talk a little bit about, towards the end of the video, why the markets are a little fickle right now. What's the actual underlying reason for the markets creating the conditions that we're trading in right now? It has to do with the dollar index, by the way. And here is the 15-minute time frame. So we had that nice little run up in here after filling in a gap right here. The idea of a buy side imbalance, sell side inefficiency, or a sell side imbalance, buy side inefficiency, SIBI, BISI, vice versa. That function of revisiting that area by the algorithm is essentially this right here. Okay, in other words, it creates such a quick movement from here to here. It's not immediate. It can be, but most of the time it's just too sudden or one-sided when it runs up and creates the imbalance, like this one over here. Like this is a buy side imbalance, sell side inefficiency. And it comes back down and fills that in to here. You see that? Because this is a intra-session, in other words, during actual market trading hours and times, it's continuous in one candle. Here, there's a break in trading, and then it restarts. So you're seeing that here, that break in the actual trading of the dollar index. It comes back down and closes that in here. Then you see that pop up. So whenever you see a gap like that and you have a bias that's bullish, if it trades above it, you're waiting for it to come back down in there, rebalance that, and then you trade higher. So the function of buy side imbalance, sell side efficiency being revisited, it's essentially this element of price delivery. It's rebalancing and offering liquidity in an area where it's absent. There was no trading here at all between this candle's close and this candle's opening. There was no trading at all. Small little tail under that candle, that was the complete amount of trading that took place or transpired from this candle's close and this candle's opening. Went down a little bit, rallied a little bit, came back down in, almost completely closed it, which is what? Consequent encroachment. Then it starts to rally and then revisit it once more here. Then only after that occurs, okay, here's the main takeaway. After that gap is closed, then you have that extrapolation to the upside. Notice that? It's the same element that the algorithm is doing here when it runs up, comes back down and rebalances all the one-sidedness of this candle. See that? Right there, then the energetic move rallying higher. So it's a repeating phenomenon, which proves that there's an algorithm. It proves that these concepts work. It proves that it's rooted on sound logic. All right, euro dollar. Here is the daily chart. Now, in my previous discussions, but you all should know this anyway, the high to the low, this area being the discount area, what PD arrays for a discount exists down here? Obviously, it's annotated for you here, but you know that low with the lowest close is what? A rejection block. Then you have consequent encroachment of the gap on that tail. Then you have the actual low. So there's 3 PD arrays in the form of a discount in this range from high to low. It retraced back up in, 3 drives higher, broke, and then we had that discussion yesterday about how it did this right here, where it ran up with a bearish bias, ran up into the fair value gap, took out the previous day's high, and then traded down below that previous day's low. Well, this candle here on Friday's trading, we opened, created a little bit of a run up, and then rejected it, and then sent it down into the rejection block. Didn't quite get down into consequent encroachment here. Got close to it, but not close enough, and then went back into an indecisive price movement. But overall, our expectation this week has been higher dollar, lower euro, and lower pound. And obviously we'll look at pound in a little bit, but we obviously got those things delivered to us. Here's the hourly chart. And I mentioned on Monday that we'd trade up into that imbalance here. It offered that, sold off, revisited the imbalance here multiple times in here, and then sold off and attacked that rejection block from the daily chart. That's what this level is here. Okay. And here's the 15-minute time frame. And I'm going to kind of go over a little bit here, give you a little bit more teaching, more meat on the bones, if you will. So euro dollar 15-minute time frame. New day here at midnight. Consolidation. We drop down below that rejection block. We're not interested in chasing price. It rallies up. What's it reaching for? Buy side liquidity. And notice this imbalance. Now I've extended it past this candle's low and this candle's high. I just brought it out here so that way you can see how it overlaps with London close. Okay, London close. You have that imbalance in the form of a sell side imbalance, buy side inefficiency. And then after London close, this is all dead time. We're not concerned with anything in here algorithmically for Forex. Okay, that's not to say that you won't see movements that can be, well, I personally would not be taking those trades. That's just me. After noontime New York local time, I'm not interested in anything Forex. It's not worth it. If I want to trade the afternoon, then you can go into the index futures and trade 130 to 340, 345 in that area and be content with that. But as far as afternoon local time, 12 p.m. New York time, for Forex, I'm not interested in because I consider this like dead time. Now, obviously, you can see it's moving and, I could take pips out of that. Why would you not want to take that? Because I'm not interested. Because most of the time, this is going to just chop around and do nothing. So why am I making mention of this? Because London close is a session kill zone. And then you have the New York open kill zone. And then you have the London kill zone. And then you have the Asian kill zone. So you would look back at midnight, look back at all of the previous session kill zones, And does it have an imbalance that we might want to revisit? That's what you're seeing here. Extend it out in time, trades up into it here, and sweeps above the buy-side liquidity pool, above these relative equal highs. So if we're bearish on euro, we needed to do what? We want to see it create a short-term premium. So inside the London close kill zone, what's the swing high? Here. And what's the swing low prior to this run up? Here. So if you have that range, this imbalance is essentially around equilibrium or so. So is it a discount still? No. So it allows you to see the market go to a short-term premium. It attacks the buy-side liquidity relative equal highs. All of this run up here is a New York session market reversal, trading into previous London close kill zone premium array in the form of a SIBI, sell-side imbalance, buy-side inefficiency. Now, this is not the first time I talked about this. It's the first time I've dressed the chart up like this so that we can see it, but I've mentioned it many times that we're looking for imbalances and PD arrays in the previous day's kill zones. That's the benefit of the kill zones. It's one of those things that draws your attention to what you're looking for. We're not hunting anything in these candles here because it's after 12 p.m. New York local time. So right here, we have that imbalance. We can refer back to that because that's exactly what the algorithm's doing. It's not going to refer back to much in here if there is an imbalance like this, dead on in the London close. This is your most recent imbalance. So all of this is time distortion. I'm not so concerned about that. So if this were a market like the open outcry where the trading sessions would end and then the market would close for hours or whatever and then restart trading the next day, and you'd have an actual gap between the new trading day's opening and the previous day's close, you would have that event that I was describing when we were looking at the dollar index where it had an actual gap there. Well, that would occur here where it would be opening here versus the close of that candle there. So the gap would exist between here and here. See that? We're assuming, okay, or I'm trying to teach you to assume that all of this price action here is irrelevant to me personally, because the algorithm is going to remember this part right there. That's the last time element from previous day that it's going to be referred to. The latest one before the changeover to a new day. Now, obviously, the new day changes in everybody else's eyes in Wellington, New Zealand. I'm not interested in following that. That's all garbage, okay? It's midnight, New York local time. So the opening of that candle and the close of that candle, that would be your separation between trading days. If it were open outcry or days where the market would close and no trading would be going on here at all, and then it starts trading here. So it would create what? An actual gap like I showed on the daily, not the daily, but the dollar index. And it would want to come back up and fill that in. So that closing price, extend that out in time. Whoops. Pretty neat, isn't it? But not only does it go to that level there, but it digs into that imbalance. See that? Here. This is 6:45 a.m. and then 7 o'clock in the morning, New York open kill zone. Then we start seeing the delivery to the downside. This low here, initial London low, approximately 10 pips. It's obviously a little bit more. It's like almost 12 pips, but just under 12 pips. But from this low here, it sweeps 10 pips or so below it and below that rejection block on the daily chart. Then we reverse back up in to the imbalance in here and then got sloppy towards the close of the day. Now, one of the things I'm going to talk about at the very end of this video is from one of the students that joined in 2021. She's a mom and she's brought some concerns and she wants some help with, time management and what she's supposed to be doing with her focus. But I want to kind of like build the idea of simplicity because I want you all starting to work towards finding your own setups, finding your own rhythm, and also realign yourself with what you're trying to do and make it streamlined and not have to feel like you got to carry every weapon on your tool belt to battle, because you just can't. You can't go to war with every possible weapon. It's going to bog you down. And that, I think, is what's been going on with the students in this mentorship. That's why a lot of the students in the free content do very well, because they don't have a lot of moving parts over here. They have a lot here. I give you everything. Like, I'm not hiding anything. I'm telling you, like, the bells and whistles about the PD arrays and how you can find this and find that. And that might feel like I'm trying to give you an excuse to be able to go back and look at hindsight so I can look smart. But I'm calling these things before it happens. And I'm showing you that there is a great deal of flexibility for you. But you don't want to be trying to take everything that I make available to you in terms of a tool or an application to make this work for you. And I'll get into that towards the end of the video. But I want to go into the model that I've been showing you on YouTube. And here's that return back up into that imbalance from the previous day's London close. So watch what occurs. We run up into it. Then we have a displacement. 2 down closed candles, sharp, 1 big candle. Obviously it's not a big candle in terms of the movement of pips, but in reference to the time element that we're in, 1 minute. We broke below this low here, so there's a market structure shift, bearish, after it trades to a premium array. We're in the New York open kill zone, and right on this candle here, that's 7 a.m., trades right up into that fair value gap. There's your short. What are you going to aim for? Well, you can aim for the London low. You can shoot for this low here, the rejection block, and hold, obviously, to see if it can reach for that old daily low, or the consequent encroachment of that old daily low's candlestick tail. So you'll be reaching for all those objectives. So getting short here, your stop loss would be above here. Preferably, I would just make it, to that candle's high. And then it rides lower, comes real close to the rejection block here, a little bit of retracement, cleans up this area here that's too clean, bumps through that, and then digs in a little bit deeper and finally sweeps that rejection block for about 30 pips or more. About 30 pips or so. So not bad. Bread and butter setup based on the model that I'm teaching on YouTube. It's concepts that you know also here, but I just took a couple pieces of what I teach in the mentorship and made a simple model. All right, so let's continue on. Here is the British pound daily chart. I mentioned we came up into the imbalance here. I said we would roll through these lows eventually here, and we got it today. So it swept through that. Didn't stay down there very long, but it did deliver. So there's one more for the annals of time. Today, we had displacement here, breaking a short-term low. There, bearish bias, looking for this low down here on the daily chart. That's what this level is here. We have a retracement back in. This is a London setup. Then the market sells off, attacking the sell side liquidity below that old daily low. Then coming back up into the imbalance here, and then obviously closing towards the low of the day, but just in a mixed manner. In the 15-minute time frame, you can see all that again. Midnight New York local time, Judas swing. We break below the short-term low. Fair value gap, trades up into it. Institutional order flow entry drill. Bam, hits it. Trades lower. Retraces back in. Institutional order flow entry drill. There. Sells off. Sweeps below the lows on the daily chart. Comes back up in. And then, again, rebalances all of this in here. So not bad for British pound, delivered like we were expecting. All right, for NASDAQ, I'm just going to take you into the 15-minute time frame because you guys can dress up your own charts and go through it as well. But the model, obviously, being taught, and I'm going to give you the dynamics here. Midnight candle. We're bearish on the indices. The market rallies, creates a Judas swing. It bumps previous day's high. What did I just talk about? on that YouTube channel. Something that you know about here, PD array in the form of a previous day's high or a previous day's low. What's above previous day's highs? Always buy side liquidity. What's below previous day's lows? Always sell side liquidity. So buy side, sell side. This market, we're bearish. Is it rallying at midnight? Yes. Does it sweep the previous day's high? Yes. Does it break a short-term low here? Yes. Does it have an imbalance here? Fair value gap? Yes. It rallies back up into that imbalance? Yes. So it breaks lower and creates another imbalance here. After taking previous day's low, retraces back up in once, twice, goes one more time, then takes out the low of the day again there. So, how many times did it sweep the previous day's low? Twice. After taking previous day's high. So this is the exact thing that I described with Eurodollar. Algorithmic. Same function, same everything. And if you read the comments in the YouTube channel, and you can quickly see now how inundated I am, because there's a lot of people here and there's a lot of people out there. And I had somebody send me an email, maybe I should just delete my innercircletrader@gmail.com email address and try not to worry with everybody. I have to keep the innercircletrader@gmail.com email address for as long as Gmail exists, because everywhere I've ever talked about anyone being able to email me, I've used that. So if anybody ever gets that email address, then it's a free-for-all then, because they can pretend to be me, and it's just, I can't do it. So, but there's a lot of emails that just never get opened or looked at. I just don't bother with them because it's just too many of them. And if you look at the comment section of the YouTube channel, you can see the most recent one, it's almost 600, not emails, but 600 comments just in less than 24 hours. That's just one video. And it's more than that with mentorship emails. It's a lot. So when you hear me talk a lot and I go on these tangents or rabbit trails or whatever, or if I'm talking about something, it feels like I'm disconnecting or going off rails, I have a little bullet point list of things that I have to touch on to make sure I address certain concerns that I see either coming by way of a number of emails or students concerned about something or a misconception, or I wasn't really clear about something and I'm revisiting an idea. That's what I'm doing. Unless I come out and tell you, it's a rant, then it's just a rant. But if you look at the YouTube comments, okay, and try not to spend too much time going through that because you have to be studying here. But for those that are able to do it and you want to spend some time going through it, look at the comment section, okay? And you all know what you know here is way more than what I'm showing over there on YouTube. The benefit is that I've taken what you have been taught with a huge kitchen sink approach where you have everything at your disposal. You can go in and pull out what you want and then start cooking. Well, over there, I gave a specific recipe, certain implementations of concepts without overloading them with a lot of things. And right away, it's resonating with them. Okay? But I stated that only the elements of time in the kill zone, operating hours basically, are slightly different when it comes to index futures and Forex. And I state that in the video. And then you have folks in the comment section, they'll say, can I use this for Forex? Or can I use this for futures? Or can we go back to futures and not talk about Forex? So it's astonishing to me how even when I sit down and show, and here's a perfect example of it. Here's the index future doing what exactly was explained and shown in the Eurodollar Forex pair yesterday. Is it not repeating the same way? It's identical. It's the same premise. It's doing the same thing I outlined in the Eurodollar. It's just slightly different, but it's the same general theme. If you're bearish, look to see if it'll bump the previous day's high. If it does it give you a short-term break below a short-term low? Yes. Did it create a fair value gap? Trade up into it. There's your short. It's pretty straightforward, right? What are you going to look for? Well, if you're bearish on the daily chart, you're going to be looking for a discount array. What's the best one? The most recent swing low. If you can't get that far, then you look at the session that was in the previous day, or if it's in the same day, look at London's low if you're bearish. If there's nothing really to work with in London, or if you already went through that, then you go back to the previous day and look at the afternoon session, look at the morning session if it's index futures, or if it's Forex, you go through to the London close swing low, you go to the New York open swing low, the London open kill zones low, whichever is lower in terms of the next one in line below market price. Because if you're bearish, like if you're bearish up here, what are you looking for? And then ultimately, you look at the previous day's low. If it's allowed to be a discount array, because the discount array of the previous day's low might not be like it is here. It could have been a higher low, and we've already went below it over here. You know what I mean? So you go through this stage of looking for what's available for liquidity, and then you just constantly keep looking through the market with that mindset, and that's a liquidity matrix. You're looking for the most likely draw on liquidity if you're bearish for sell side liquidity, and they're at logical places. It's not a mystery. It's not something that should be hard for you to come up with in terms of a understanding why it should draw there, and it might not go there. Like it didn't go to consequent encroachment of the daily low on the euro, and it didn't go ultimately to its daily low. Because obviously, if it's not going to go to its consequent encroachment on that lowest candle on the daily chart for euro dollar, then it obviously can't be going to its lowest low on that swing low. But it went down below the rejection block. So you're setting yourself objectives to see if you can reach to that. And each one of them is a potential target, either for scaling out partials or your ultimate target. But when we get to Friday, you got to be real nimble and be ready to take a nice discount array that makes sense. Take majority of your trade off, like 80%, 75% of the position off. And then if you want to hold on to something and get maybe an afternoon continuation, that's something you can do, but don't do it with your entire position, because you're just asking for, a retracement that would either take majority, if not all of it, away from you. But you can see it just goes right below the previous day's low here, and then once more here after going back up in the DM bounce there. High to low, premium, imbalance, after New York lunch, then we run for this swing low, the low of the day, and back below the previous day's low. Why would it go back below the previous day's low? Because it already did it here. Why did it want to go down there again? Obviously it sweeps this, but it's really not so much that it's just sweeping below here. Think about what's occurred. It went down below the previous day's low there, then starts rallying. Traders that are long or wanting to be long, they're going to buy that, and they're going to put their stop loss below that over there. Because what do we see? Low, low. That's a double bottom to retail. It only goes up to a premium here after lunch, New York lunch, and then trades down once more to attack them. So, the more you know. All right, so what I have here is the CRB index, and you can find this on TradingView. Just type in CRB index, and it'll give you this name here. And then click on that. And then I did a compare tab and applied the dollar index. Okay. Now, obviously in the teachings, in the core content, I teach you that there is a inverse relationship between the dollar index and the commodity markets. When one's going up, the other one's going down. Okay. That's just the normal inflationary, elements in the event that takes place between these two barometers. So the currency lately, since May of 2021, dollar has been going higher. notice that it's also being seen that commodities are going higher. This makes the markets very difficult to have sustained trends. It makes it choppy. It makes it erratic. You'll have movements, and then you'll have these sudden crashes. Not huge market crashes, but I'm answering Jason with this inquiry. Like, what's the reason why? Obviously, there's a lot of things going on with the economy and global stuff, and it causes concern. Money is seeking yield, and they're always trying to find a way to make money on money. But what's causing the markets to be erratic, consolidated? Why is euro and British pound trying not to move so much? This right here is one of the underlying reasons, because the dollar index honestly should be dropping. It should be going lower while the commodity markets are going higher. But we're seeing them move together in concert. And what that creates is a disconnect and decoupling between normalcy in price delivery across the board with commodities and dollar. For instance, what we saw, the grain markets, the big rally up in grains I called over the last year or so, that was accompanied with a dollar that was firming. The dollar was going up the whole time. That should not be going on. That generally should not be there. Oil price has been going up too. The stock market started going high. It's all these things are moving, and it creates a element where you don't really know what to trust. Okay? And that's what makes these conditions the hardest it's ever been. Plus, with all the other things, just on the horizon, you have all this stuff that you've heard me talk about that many of you don't like me talking about, but you know what I'm referring to. Okay, I'm trying to spare some feelings here. So, when you look at this storyline like that, it makes it, at least in my mind, it should be easier for you to understand why there is this underlying stress in the marketplace, because they should be at opposite, back and forth, like a teeter-totter. Okay, one goes up, one goes down. Now, there's going to be short little periods where they may move in sync together, but generally, when they move, like a long, drawn-out process, there's something going on geopolitically, something war-related. It's always something like that that's causing that underlying strain and stress. And it creates a really difficult market condition. Not to say there isn't opportunities, because obviously there's opportunities. The markets are moving, but we're not seeing these really nice, pretty sustained trends where they just swing real nice higher, and it's just measured moves and just real nice precision. It creates chaos sometimes. Okay, and that's what I mean when I stated in the videos here with you all, and when I mentioned it on YouTube. This is the hardest market environment to be in my mind, in history, because you have all kinds of things going on that make it difficult to participate. You have a new thing always constantly challenging your resolve. What's going to happen if the housing market collapses? What happens if, another war breaks out? What happens if, the interest rates are raised to exceedingly high levels in the U.S.? Like they're saying they're going to do, a couple 50-point basis increases, over the course of this year. If that happens, that's going to create a lot of things in the housing market, and that housing market would collapse. And that collapse in the housing market would drive ripples pretty big through the stock market, then the commodity markets, and obviously the interest rate market, which would create a huge ripple in the futures. Not the futures, but the Forex market, because currencies are directly linked to interest rates. So all these things are a factor, and it's creating like a perfect storm for really big big moves in price, but we have to weather all of this right now because of what's going on here. How long will this last? You're probably going to ask. I don't know. I don't know how to know how long it's going to last, but you have to just constantly keep monitoring it. And what I'm watching is when these things start moving in opposite directions. Okay. And it won't happen like immediately where you'll see, oh, here it is, it's turning, and it takes a little bit of time, probably like 3 to 4 months. You'll start seeing some kind of a relationship where one's going higher and the other one's going lower. And that's a normalcy signature where that's what you want to see. But when it's like this unfortunately creates huge mega trades in the commodity markets, because that's what it's signifying here. The fact that commodity prices are going up even while the dollar's going up, so I'm going to put it in layman's terms so that we understand why this isn't a bad thing. It creates a different kind of marketplace. So in these environments, you want to be looking for markets to have a premium in the commodity market delivery month. Okay, not premium to discount like the PD array matrix. I'm not referring to premium in that regard. I'm talking about like if you're looking at the grain market. Right now, the month that we're going to be trading is May. So May grains, then you go into July. And then from July, you go to September. And then September, you go into December. Those delivery months, you want to see them generally be more expensive as you go further away into the next calendar months in the distant. Okay, for instance, May's contract should be cheaper than that of July, and July should be cheaper than that of September, and September should be cheaper in its price than of December. And what I mean by price, whatever the closing price is or the actual market price for that individual grain market, like corn, soybeans, wheat, the actual contract price that's trading at the moment, they should be more expensive further away than the calendar date that we're looking at it at that time. That's a normal carrying charge market. In these environments where the dollar's moving in concert higher with commodities, that changes everything to commercial bull market. So commercial bull markets is when you want to be looking for the markets, obviously, that are in a premium. That means there's a reverse, backwardization of now the nearby contract, May, corn, soybeans, wheat, oats. Those prices on May are higher than July contract, and July is higher than September's contract, and September's contract is higher than that of December of 2022. That's a backwardization. The only time that occurs is when the commercial users and producers of that particular commodity, they build in a premium because they have to pay for higher costs right now. And because of that higher cost, the concern is these large commercial users that have to purchase these commodities to do business and operate, they have to buy huge amounts of it. So like imagine a cereal company like Kellogg's in the United States. If they're going to be doing a lot of work with making cereal, and most of it's corn product and oats, if they're going to be making cereal, which is what they make their profits on, they have to buy a lot of that grain. And if they know that the underlying fundamentals are suggesting that the price is going to be much higher later on, they're going to be buying a whole lot more of it in the front months, like May and July. Those contracts are going to be bid up a lot. So that creates that underlying tone, which is why I stated and why I've been saying that we're going to see a big run up in and continuation of the grain markets because of this relationship here. Okay, that's how I was able to tell you that. That's how I was able to tell you, you don't think that we're done with the grains. And before I went away for March's break that I took, and then we had the issues with the Russia-Ukraine thing, and Russia saying they're not going to export their wheat. And then obviously we had all those days that wheat went up, limit up. So there's that relationship to the underlying fundamentals, what I'm showing you here, and then the relationship of how the contract months are in backwardization. It's not a normal carrying charge market. It's backwardization. That means the nearby contracts are selling for more money. When that happens in this environment like this is occurring, that is mega trade conditions. Like this is what it looks like, folks. So that way you understand how to look for it. So if anything ever happens to ICT, I'm no longer around you. I've moved on to the promised land. I'm no longer with you. This is what you teach your children to do. Okay, you look for these types of things, and it creates the environments that we're in. But unfortunately, for markets that are not in those types of conditions, it creates choppy, whipsaw, indecisive type movement. You notice that? Yeah, there's trades moving around. But when the grains were going higher, while this event was being seen as I'm showing you on this chart right now, all those things being there, those moves in the grains were just like little tiny Bitcoin rallies. Okay? Just really nice little boom, 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 boom. Like the 2017 run up in Bitcoin. It was kind of like a mini version of that, which is what I say all the time. Every year there's a mega trade. But we have a stage set right now that is incredibly promising. Like I'm excited. So for the student that was asking, what gives me that visibility? What gives me the idea that this is likely to occur? And obviously we've seen them happen now. This is what I'm watched. This is what I'm looking at. And I mentioned before how in the core content, these conditions obviously are inverted. But when we have a condition like it is right now, where both are moving in the same direction, because dollar's going higher and commodities keep going higher, that really, really underscores the necessity for these big commercial users to be buying a whole lot of all these things right now. They have to prepare for it because they can't afford to wait to buy it later and do business with a higher price even later on in the year or maybe into the next year. Okay, because the supply chain issues and such. So, and when it comes to fertilizer, that's really going to impact the grain markets. And that's why, again, I give you that information because they are all fundamental catalysts to why and how these markets could literally go into the stratosphere. All right, time management. Got an email from Siobhan, and I'm going to read it to you. Okay, I would otherwise say here, just read it, but I kind of like to give you a feel for what she's asked here. She says, "Hi, Michael. I need help trying to figure out the best way to study. I find myself watching more videos than chart time, but I still need to review the videos to understand concepts. I'm genuinely interested in learning the concepts and not rushing into demo. Can you give me some type of insight as to whether my current study model is wrong? I'm a single mother of a 5-year-old and a 3-year-old. I work Monday through Friday, 7 a.m. to 5:30 p.m. Yes, that is a 50-hour work week. I'm familiar with them, and they were not fun. After my kids have gone to bed at 8 p.m., I start studying from 9 p.m. to 11 p.m., sometimes till midnight. Her schedule is Monday, she marks up higher time frame charts on dollar index, euro, cable, NASDAQ, even the S&P, and the 10-year bond futures contract for forecasting and using the daily trade worksheet from core content month 12. Tuesday through Thursday, same as above, plus mark up YouTube model trades based on higher time frame levels that occurred during trading day. Friday and Sunday, she watches 4 videos a day, no chart time, reviewed 2021 core content, 2016 content, 2021 commentary, and present commentary. She says that she's a 2021 group student and just needs more direction on how to best spend the time. And she feels like she needs more chart time to train her eye, but has a hard time piecing together concepts. She doesn't know if she can blame it on herself being tired or if she needs some direction by me to help streamline her approach based on her current situation. Then she goes on to ask, is what she's doing right now too much? Is she doing too many things at one time? And should she watch a concept then train her eye before she moves on to something else? And that's her username. And if you find her in the forum, this is who she is. Okay. I kept your last name out, and I appreciate you giving me permission to use the email here to kind of like frame. These are the types of things, okay, when I'm talking and it feels like I'm not talking about trading related things, I'm addressing these types of questions and concerns, and I'm trying to incorporate them then in the delivery of the content, mixing it in there so that way I'm not droning on just with the charts, because it's not just the charts. There's other things that I have to address, and I don't want to make separate videos just for these types of things, so I kind of incorporate it all. So I'm giving you, again, like I did most recently, another lady in our group, a chance to have their concerns addressed, and then also show you why I teach the way I teach and talk the way I talk in the commentaries, okay? All right, so let's get into it. Right away, I'm going to give you a plan of action. This is my suggestion. Obviously, you're welcome to make this how you want to, implement it for your personal approach. But right away, what screams as the number one issue is you are absolutely trying to do too many things. Okay, and it's going to create analysis paralysis. It's going to make you feel like you're never going to get it. And honestly, this is what I wasted time with for the first years. Okay, the first years of my trying to learn how to trade and figure out what it is I'm trying to do, I was always doing too many things and never practicing to get good at one thing. Okay, I've done lessons before, and you're a 2021 group student, so you probably haven't heard me teach on this topic, but I've mentioned it a couple times throughout the last 6 years or so doing this mentorship. And I mentioned it once or twice on the free teachings on my YouTube channel. And the concept is, and I learned this from the magician, Jeff McBride, because I'm a younger man. I was an amateur magician. It's just for fun. I've always been intrigued with it. But he lectured on how magicians get into that craft and they try to learn every magic trick, every sleight of hand, and try to do everything they can possibly get your hands on. But they never do well at practicing to get one thing understood and do that one thing well. And it's kind of like what Bruce Lee said, he doesn't fear the guy that can, throw the fastest kick or something to that effect. He's more concerned about the guy that's practiced one kick 10,000 times. Okay. You're looking at a lot of things. You're trying to, in my mind, this is kind of like you feel like you have to get there quick. You're a single mom, you have a lot of responsibility on you, you're working a lot of hours, and you're trying to make it work for you. And I can fully appreciate that, and I've been there. But you have to slow down, okay? If you and I were together and we were one-on-one and you were coming to me for guidance on how to do this problem right here that you're showing me here, you'd be surprised that this is 90% of the time what most of my one-on-one mentorship individuals brought me. They gave me this problem, okay? They would say, okay, this is what I'm trying to do. Give me a way where I can keep doing all of this, but do it right. And my solution to you is the same way I'm going to tell you I told them. You have to pick 1 or 2 markets. That's it. Okay, so you're going to do that first. You cannot be worrying about all these things, okay, and feel dialed in, because you're still trying to discover, number one, yourself in all of this. And right now, you're not even going to recognize growth because you're too stressed out trying to put too many things on your plate. I've done this, and every new trader does this. And I'm going to give you the permission to liberate yourself right now. If you're going to be trading Forex, pick one pair. Have a closely correlated pair to it. Obviously, that's why I teach cable and fiber. Eurodollar versus cable. And then obviously you have to refer to the dollar index. So there's 3 markets, but you're trading one. Commit to that. You're going to be a cable trader. That means you're only going to trade on pound. You're going to be a fiber trader. That's it. You're only going to trade on Eurodollar. But you're going to look at all 3 to get a feel for when it's likely to move. Now, there are times when you're going to be wanting to take a trade long because the dollar's going lower. It may not give you a clean cut trade in the pair that you want to trade, but the other one moves. Who cares? You missed it. Teach yourself discipline not to worry about that move. Stay on one market. You're going to learn a lot about yourself, and you're going to correct bad habits that you don't realize you have right now. But the number one concern right now is you're spending too much time doing too many things, and you're never going to get good at any one of them in a noticeable manner to keep you motivated to keep doing. Because what's going to happen if you don't make these changes, I'm telling you, you're going to burn out. You're going to burn out, and you're going to get frustrated, and you're going to want to quit. And it's going to be the easiest thing one day that you're going to say, I'm done with this. This stuff doesn't work. I'm never going to do it. I can't be a trader. And that's a lie. That's not true. You can do this, but you have to do it correctly. So your decision is to pick one of these markets. And now I have a member from 2016. His name's Ken. And I've been counseling him in email. He wanted to throw in the towel too. He's like, I can't make it work. I can't make it work. And we're going through the processes of finding where his demons are that's holding him back. And my suggestion to him, and my suggestion is to you, okay? And I'm going to kind of like slowly take this whole community. I'm kind of letting you know right now. I'm slowly going to take the community to following majority of the time the model I've taught on YouTube. Now, number one reason why I'm doing that is it makes it easier for me because I know invariably I'm going to mess up. Okay, I'm going to end up saying something that is going to be an overlap of what I'm teaching here. It's going to find its way in that video on YouTube, and I don't want that. I'm going to lose track of what community I'm talking to, and it's just going to be uploaded, and it's going to be there, and I don't want to be deleting videos and stuff because I don't change and edit anything in here either. So I'm going to streamline everything with that. So that way my time spent in charts, in creating lessons, will be the most economical way of doing it. I'll touch on where you can apply the other things in this content here and all the advanced stuff, where you can plug that into that model. You don't need it, clearly. You've already seen that. But my advice to you is don't look at the YouTube model as, oh, well, that's something less than mentorship. We're high society over here, and that's the commoners. The commoners are eating like that. We're going to eat the filet mignon here. Don't think that way, because I'm literally calling that model 13. Okay? So I'm dressing this model up not only for my daughter, but I'm going to work with it in this mentorship for one particular student's benefit. Okay? So that way I can show him that he can do this, but you're all going to benefit from it. Okay? So pick one market, settle in on it. It could be an index future. It can be, because I can see you're looking at index futures, and you're looking at the model over on YouTube, and you're looking at all the other things here, and it's too much. It really is way too much. But I promised that I would literally turn the fire hose on here and teach everything that I'm willing to teach, and it's a lot of content. But I also taught how you can take these pieces and put them together with the models and other lectures. Avoid overloading your study time. Okay, I think that 3 hours a night is too much. And I know it feels like, well, if I do an hour, it's not enough. If I just do 2 hours, it's really not enough. You need to think about how you're studying, because if you're studying and you're fatigued and you're tired, you're retaining nothing. You're just creating that stressful environment where your body's going to start producing cortisol and stress hormones are going to release, and you can't retain anything with that. It feels like you're working hard, but you're doing everything wrong in terms of giving yourself too much stress. You're putting way too much on you, and you don't need it to be that strenuous. You want to make it pleasant. You want to be able to relax and obviously balance everything you got to do as a mom and still work and be productive in that regard. But try not to overload your study time. Limit your study time to 2 hours maximum. Okay. Inside that 2 hours, what are you going to be doing? You're going to look at the commentaries that I put up, if it's that particular day, and you're going to get the current bias. What am I suggesting in that video in terms of where the market's likely to go? Because I'm trying to point to where your study should be in alignment with that. Now, I'm sometimes wrong, but for the most part, I'm guiding you in the right direction. So if you go into your charts studying with that in mind, try not to do the opposite. Try not to fade that, okay? By submitting to that process, you'll start seeing the tools speak easier to you in your study, and you won't need to be doing so much of it. It feels like it's counterproductive to say do less, spend less time, and get better results. But that's exactly what you're going to do. And you're going to discover that's the truth. You want to watch 1 video per day of core content. On the weekends, I see you're doing like 4. You're never retaining it. There's no rush to get this stuff done. And you don't need to have that much watched. You can't. Like, you could have the favorite actor, the favorite, celebrity, and follow them throughout your working career, and watch their movies and do a binge watch of 4 brand new movies that you've never seen by that person, back to back. And if someone asked you about certain scenes in every one of those movies, you could not say every detail that you remember seeing in the video or watching that feature film. You can't retain all that. And this is the same way, but this is even worse in regards to retaining because it's highly technical. And there's a lot of things and a lot of moving parts, and you're just giving yourself way too many videos to watch. Don't do that, okay? 1 video per day maximum in the core content. Now, if you're obviously doing a day where I did like a Friday or a Wednesday or a Monday, until we get to June, when the videos no longer are the medium, you'll have plenty of time to start going in and watching more videos then, because you won't have to keep up with this. It'll be you go to the forum and I post my ideas in a chart, really short annotations. This is where I think it's going to go. The draw on liquidity makes it real quick, short. My time's better spent. Your time's better spent. And it frees you up, all of you, to go back and rehash the lessons and the lectures and the videos. But inside of your 2-hour maximum study time, you have to apply 15-minute maximum daily study log entry. Now, what are you doing in that? You're going through your daily, your hourly, and your 15-minute time frame, and you're breaking them down, looking at the PD arrays, looking at what the bias was from the previous commentary. How has the market delivered price? What signatures do you see? Annotate your chart. What do you observe? How much did it move against the back-tested idea? Okay, so you're looking at what the market did, framing everything in hindsight, and then screen capturing that from the daily chart. That's one screenshot. The hourly chart with your own annotations there too, and the 15-minute time frame. So each chart should take you no more than 5 minutes. If you spend more than 5 minutes, you're really doing too much. It needs to be obvious and it leaps off the chart. If it doesn't leap off the chart, you'll see over time your observation skills will obviously improve. And the things that you're going to be annotating in the beginning will be very short, little brief observations. But over time, weeks and months and years, you'll have a richer perspective on what you're seeing in price action. And by a default, doing that and keeping a study log, you'll have your study journal that you'll look at on the weekend. So instead of watching 4 videos in no chart time, that's where you do all your chart time. You refer back to your study journal entries and you compare and contrast what it did versus the previous week. How did it, trade each day on Monday through Friday? Which day did it create the high of the week, the low of the week? What kind of profile was it? Was it consolidation? Was it a bullish week? Was it a bearish week? Those types of things. And you want to annotate what you think these weekly profiles have produced in terms of most recently, the week that just closed, assuming like it's a Saturday or Sunday, like tomorrow or Sunday, you'll be doing this. And then compare also the previous week. and you go through your study journal and be organized with it. And weekends only, back test maximum 60 minutes. Okay, so you have to have a balance, okay? And this seems very hectic to me. And I got really stressed out reading it because I could imagine how you probably feel like an avalanche is on you, okay? Or trying to outrun an avalanche. And every time I put something out new, it's like, oh my goodness, I'm just getting deeper and deeper in it. And it can be scary and it can be overwhelming. That's why I tell everybody to be patient with yourself and try not to rush through this. You're going to find that your model is very simple and you've been trying to make it more complicated than it's required to be. That's why I did what I did on the YouTube channel. Okay. I'm showing you that is very simple. I just showed you here another example in this lecture, in this commentary, that it occurred exactly what I outlined in the Eurodollar over there. It did it here in the NASDAQ today. So it's a real simple procedure of looking for simple things that will repeat. But on the weekend, try not to binge watch. Okay, 4 videos, it's too many. It's too many. So on the weekend, you want to spend your time looking at charts because you're not being influenced by the moving market price. It's static. So that way, it's not going to change your mind. It's not going to entice you to think, okay, I'm probably wrong about that. It's going to go here. It's going to go here. You don't have anything to worry about. You don't know what it's doing right now because it's not moving, okay? It's not likely to go higher. It's not likely to go lower. It's stationary. It's static. And you want to take advantage of that quietness and stillness and look at your charts that you've collected data from Monday through Friday. Now, if I could say what's the most important thing, watching new videos by me or doing the back testing on what you've already been accustomed to learning and what I'm showing you in the commentaries, I would say your own back testing and keeping up with the commentaries that I'm giving you, the bias and what's likely to happen. Because if you have a general familiar understanding of the core principles I'm teaching here, the element that's going to bring the confidence, the relaxation, the removal of, I got to have it real quick. I feel like I'm never going to get this and I have to because maybe it's financial that you want to try to change and you want to improve things for yourself and your family. If you rush that part, if you try to push really, really hard on that, it makes it slower. I know it feels like I'm going to work hard. I'm really going to pour myself into this and I'm going to do this. All I'm asking you to do is do a little bit less and change the way you're doing it. Okay? Don't watch a lot of videos on the weekend. That's the time when you actually go through the charts when they're not moving and dig into them and annotate them, because your greatest learning, and this is for all of you listening, your greatest learning and the learning curve is shortened by the back testing and going in and creating your own chart annotations and discovering the things I'm teaching you. They don't have to be everything. You're not trying to apply central bank dealers range. You're not trying to do flout. You're not trying to do all these other things. Honestly, just for the rest of this year, try to work with what I'm showing you that's been stripped down, very simplistic. And I'm certain that at least a third of you are going to be like, you know what? This is it. I think this is what I'm going to work with. I don't have to worry about being Mr. Perfect or Mrs. Perfect with the highest high of the day, the lowest low of the day with central bank dealers range and flout measurements and Asian range projections. You don't need to have all that stuff. All you need to do is find a small pound of flesh. Whenever you're going to sit down in front of the charts, get it, move to the sidelines, and be content with that. That's my best advice to you. That's my best advice to every student here. I'm a freak when it comes to technical precision elements and things that make it go here or there, because I'm intrigued by that. As a child, I took things apart just to see why they worked the way they did. And I don't know why they were doing it, but I needed to see the inside parts. So that's what I show you. I show you the nuts and bolts, knowing and warning everybody in advance that some of you aren't going to be this interested once you have it all in front of you. You're like, okay, well, this is too much. And there's a way to take things from all that and make your unique model. But I'm showcasing to the public, everybody, and you here, that what I'm teaching can be simplified down to something that repeats very, very easy, and it's easy to identify, and it's something that doesn't take a lot of technical understanding. It's just a couple repeating things that I've taught with a great deal of detail over the years. And it doesn't require you to be that technically acrobatic. And it doesn't require Olympic feat of strength and tenacity to stick to. It's really simple stuff. And my hope is that this has given you at least a little bit of peace of mind, knowing that your desire and your tenacity is very, very needed to do this. But you just need to change your gears a little bit and redirect yourself with some of the things you're doing. Try to do a little bit less. You'll retain more and focus more of your studying on the weekend in the charts. Video studying is 1 video a night, and then back testing and doing your study journal. That should be 2 hours max. And I'm saying really technically, not like 90 minutes or less. That's really the ideal. I mean, I know sometimes I make a very long video, and that might obviously eat into some of that study time, but be real diligent about, scheduling your time. So if you're saying between 9 o'clock, when your children are at bed, schedule yourself, 10:30, you're done. And that way you can go to bed laying your head down, relaxed, because rest is really, really important. If you don't find a way to disconnect, you're always on edge. And I was always on edge in the 90s. Like I barely had any sleep. And I was very hard to be around, which is why I kept myself single. And it was tearing my health up. Like I couldn't contain myself, in a stable manner, because I was constantly pursuing a way to get out of that rat race type job. I didn't want to be there. I didn't want to be doing those things. So I felt like you feel here, and it's admirable. It makes sense, right? The harder you work and press into this stuff, doing the things that you think are the right way of doing it, if you just change the order of what you're doing, spend a little less time doing it, but be more organized and preserve your rest and your health. That's paramount, because it doesn't make a difference how much I teach you and how much you make in the marketplace. If your health is diminished or removed because of fatigue sets in disease and you can't work at optimal levels, you still have to work. And then when you come home, you're mom. Like you're it. Like you got to take care of all that stuff. And your children are going to see when you're stressed out. They may not say it. I mean, they're pretty young, but they're going to know it. And you don't want your children being the recipient of the mom that's stressed out, that's trying to do all the right things. Because I can see that's what you're trying to do. The fact that you joined this and you sacrifice the payments and the time doing it, and if this is what you're doing, you're definitely sacrificing time. But just make the subtle changes that I'm asking you to do here, and I promise you're going to start seeing different results. And you won't feel so overwhelmed, and it'll start coming easier to you. You'll be more organized. You'll be more well rested, because when you lay your head down at night after you're doing it this way I'm suggesting, you won't feel like you didn't do enough. Because that's probably what it feels like sometimes when you're laying your head down at night. You're laying there and you're thinking to yourself, I don't know how this works and that works, but I've watched this and this and this and this, and I can't get these things to fit together. Because all you're doing is heaping more helpings on your plate, and you can only digest so much. You can't consume the content, retain it, filter it out, and match it with your own personality if you're giving yourself this much of an onslaught of information. It becomes analysis paralysis and information overload. And if you feel like you're underwater, barely able to breathe, it's because you're pulling too much on top of you. And just all you have to do is slow down. Just slow down and take a little bit more measured portions of the content and manage your time more efficiently in doing what I'm suggesting here. The back testing on the weekend, the studying of the charts that way, you're going to find that that's the better learning because you're looking for it actually in the chart. It looks to me like you're looking at the videos like it's going to somehow make it like it downloads from the video into your understanding. The only thing I'm doing is demonstrating the concept. But once you have that demonstration of the concept in the core content lesson, you have to have that found by your own back testing. And you do that every day. You do your little markups on the daily, hourly, 15-minute time frame. Then you aren't going to appreciate how those things work together throughout the entire week until the weekend, when you start looking at how the whole week moved and how each individual day created that one particular move that set up the largest portion of the weekly range movement, higher or lower. And by doing that, you won't appreciate so much in the first couple of weeks because you're like, okay, I don't know what I'm looking for. But then suddenly over time, you're going to start seeing things that, hey, I remember seeing this. This is starting to make sense. Why am I focused on this one little particular thing? It keeps popping up. And all of a sudden that becomes and morphs into your model. That's the thing that your attention gravitates to in the chart. And whatever that is for you, that's where you bloom. That's where you plant yourself and you bloom right there. You don't try to do anything else that I taught anywhere in the mentorship, because the first thing that resonates with you, you have to cultivate that. Work with that, because it's going to yield the most, the easiest, and the fastest, because you've connected with something. What would that be like? Well, the fair value gap, like the model I'm teaching, or it could be a breaker. It could be institutional order flow in the New York session after London creates a suggested high of the day when it's bearish, and you have relative equal lows that it's reaching for on a 1 hour or 4 hour chart. I mean, these are all just simple suggestions, and it's not limited to something like that. There is so many ways for you to frame your own model, but I don't want to be the instigation that causes you to only settle in on one thing because I said I like something or I'm using something, which is very difficult for me as a mentor because I want to demonstrate everything, like the magician in me. Okay, I want to show you all the tricks, but I want you to find that application of these tools that fits your personality. Because once you do that, and you're only going to do that by doing what I'm suggesting here, okay, you won't stress yourself out no more. You'll have a restful night's sleep. Your time will be freed up. You can spend more time doing something else disconnected from me, from my mentorship videos, and the marketplace. You have to have that. And it doesn't appear that you have much time for that. And you have to make a plan of doing that. So, in my humble opinion, this is my best response to this. It may not have answered it for you. And if it didn't, I apologize. I really put some thought into this. I feel like, if I were you, this is something that I think would be received, gladly if it were me. But I understand that there may be other factors in your life that this doesn't address and maybe creates other, concerns. But really switch the things I've asked you to switch. Focus more on the study time in the weekend for backtesting and charting and how everything fit together. That time is best spent that way, not watching videos. Okay? And I promise you, if you do that over a couple months, you're going to see a greater learning curve, acceleration, and you'll probably start enjoying it a whole lot more and not feel like you're being drowned. So until I talk to you guys on Monday, enjoy your weekend. Be safe.